Here are really just a few of the headlines from articles, emails, fund manager blogs from just the last week or so. What happens if the AI bubble pops? Bubbles and diversification. The biology of bubbles. What will happen if the AI bubble bursts? That was The Economist. AI, artificial immortality? Is AI a boom or a bubble? Less AI bubble than bubble bath. So, not sure if I'm jumping on the proverbial bandwagon here or honing in on a matter of great interest and bearing to our business and our clients. Well, let's see. If you're not in the middle of all this, if maybe you have investments but you just let them or us get on with it for you, or you glaze over at the first glance of this stuff in the paper, if you still read or get one, well, here's what it's all about. The US stock market is up by somewhere between 15 and 20% over the past 12 months, depending on which bit and how broadly you measure it. It makes up over 60% of the worth of the world's stock markets, so it is, like it or not, the main influence on them all, even or particularly, depending on your view, in the age of Trump. And here's the point. Most of that growth has come from the increase in the value of the big tech companies making most of the stuff which powers AI. The hardware, the software, and the infrastructure, of which there is a lot needed. Now, if AI is the future, and they go from strength to strength and make as much money from it all as everyone's betting they will, then everything will be fine. If not, or if it doesn't happen that quickly, or if all those investors change their minds and pull out, then their shares will go down in value, maybe very quickly. Everyone will panic. Stock markets will crash. Now, there have been other so-called bubbles throughout history. The railways in the last century, the South Sea bubble here in the one before, the dot-com bubble more recently. Well, will it happen? And is this a bubble? That's what all those articles are about, of course. Some are basic, some are learned, some require a degree in something I don't have a degree in to understand, but here are my thoughts for what, if anything, they're worth. First, at a very basic level, if shares and markets went up at 15 to 20% a year, every year, wouldn't it all be easy? If it was the norm, well, we'd have inflation of maybe 10 or 15% or more, which would make those sort of increases look not very much. We haven't. So in the scheme of things, the lesson of history is that it will all go down at some time, then go up again. And the averages will kick in. When, though, will it go down? Well, a bit more history here. If you were a grown-up in the 1980s, you may remember a character called Bob Beckman. He was on the radio and TV a lot. A sort of more miserable and less useful Martin Lewis of his time. He said from around 1980 that stock markets were going to crash. Get out while you can. They did, but not until 1987. And had you listened to him and cashed in 1980, you'd have missed out on several years of boom. And if you stayed invested through the crash, well, you'd have come out smiling after a year or two. He also incidentally said in 1979 that property markets would crash, which again they did, but 10 years later, after booming through the 1980s, as many of you will remember, he made a very lucrative career out of it all, and many at the time thought him the investment messiah. So, message there, once again, it will go down, but no one, even a messiah, knows when. Now, a lot of more technical stuff. Many investment experts measure the value of a company by something called the PE, the price earnings ratio, which hang on here with me, multiplies the number of shares in a company by the price of those shares, then looks at how many years' profits it takes to make up that value. Now, the average for our stock market is 19 times, and the average for those big tech companies is around 30 times. That means that it will take 30 years of their profits now to actually earn the value of the company. And that shows you the extent of the bet on their future profits that everyone buying their shares is making. And if you have any investments anywhere, you're probably one of those people making the bet, even though you might not know it, because it's difficult for funds, particularly the lower cost passive or index tracker funds, not to have their shares. So what am I telling you here? That yes, stock markets will go down because they can't always go up, which is why we always tell you, if you're a client, to keep enough in the bank or premium bonds to weather the storms that will happen. That no one knows when they will go down, and if you try to guess, you will miss out, usually on more gains than you'll avoid in losses. And well, from one of those articles, a very interesting thought. If you knew for certain that a property price crash was coming, would you sell your house, bank the money, and move into rented, which is the equivalent of selling your investments, your shares, putting the money in the bank? No. I bet you'd be telling me that you know the value of property always goes up in the end, so you'd stay put. And there, I guess, you have it.